In 2005, the American economy looked unstoppable. House prices were rising every year, banks were making record profits, and millions of people believed real estate was the safest investment on earth. Television experts celebrated the housing boom, investors poured money into mortgage-backed securities, and Wall Street executives collected enormous bonuses. It seemed like everyone was making money. But in a small office far away from the excitement, one man was studying something that almost nobody else cared about. His name was Michael Burry. Unlike most investors, Burry wasn't interested in headlines or market hype. He spent his days reading thousands of pages of financial documents, searching for risks hidden beneath the surface. What he discovered would eventually shake the entire global economy. As he examined mortgage data, he noticed something strange. Banks were lending money to people with poor credit, unstable incomes, and little ability to repay their loans. Some borrowers didn't even have to prove their income, others received loans with low introductory payments that would later become much more expensive. At first glance, these mortgages seemed harmless, but when Burry looked deeper, he realized that millions of homeowners would eventually struggle to make their payments. To him, it wasn't just a few bad loans, it was a ticking time bomb hidden inside the financial system. Now imagine being the only person in a crowded room who smells smoke. Everyone else is laughing, celebrating, and enjoying the party. Do you stay quiet? Or do you warn everyone, knowing they'll probably think you're crazy? That was Michael Burry's problem. The strange part was that nobody seemed worried. Banks bundled these risky mortgages together and sold them as investments. Credit rating agencies labeled many of these securities as safe. Pension funds, insurance companies, and investors around the world bought them without fully understanding the risks. The entire system depended on one assumption: housing prices would continue rising forever. But Burry knew that nothing rises forever. As he continued his research, the evidence became impossible to ignore. More and more loans were being issued to borrowers who couldn't afford them. Mortgage brokers earned commissions for creating loans regardless of whether borrowers could repay them. Banks earned fees by packaging and selling these loans. Everyone had an incentive to keep the machine running. Nobody wanted to ask what would happen if housing prices stopped rising. Burry did ask that question, and the answer terrified him. Most investors would have simply avoided the housing market. Burry decided to do something far more extreme. He wanted to bet against it. The problem was that almost nobody believed the housing market could collapse. Banks were so confident in real estate that they were willing to create financial contracts allowing Burry to profit if mortgages failed. These contracts, known as credit default swaps, acted like insurance policies against mortgage-backed securities. Burry began buying them aggressively. Think about how absurd this looked at the time. Imagine standing in the middle of a desert and buying flood insurance. That's how ridiculous his trade seemed to everyone else. He was essentially paying banks millions of dollars every year in exchange for the right to collect enormous payouts if the housing market crashed. It was a bold move. Some would say it was reckless. After all, he was betting against one of the strongest economic trends in America. At first, nothing happened. Housing prices continued rising. The media remained optimistic. Wall Street celebrated record profits. Investors questioned Burry's judgment. Some became angry. His own clients began demanding explanations. Many thought he had lost his mind. Imagine watching everyone around you become richer while your investment appears to lose money every month. Imagine being mocked by experts, questioned by clients, and doubted by friends. Most people would have folded under the pressure. Would you have held your position? Would you have trusted your research if the entire financial world told you that you were wrong? Michael Burry did. He understood something that many investors never learn. Being early often looks exactly like being wrong. Months turned into years. The pressure continued building, but beneath the surface, the housing market was beginning to crack. Mortgage defaults started increasing. Borrowers struggled to make payments. The number of foreclosures began rising. Housing prices stopped climbing, then they started falling. Suddenly, the assumptions supporting the entire financial system began collapsing. Financial institutions realized that many mortgage-backed securities were far riskier than they had believed. Investors rushed to sell. Panic spread throughout Wall Street. the machine that had generated enormous profits for years began breaking apart. What happened next became one of the most devastating financial crises in modern history. Major banks failed, investment firms collapsed, credit markets froze, businesses struggled to borrow money, millions of people lost their jobs, families lost homes they had spent years trying to afford, retirement accounts were devastated, trillions of dollars in wealth disappeared. The crisis that Michael Burry had warned about was no longer a theory, it was reality. As the collapse intensified, Burry's position exploded in value. The contracts he had purchased suddenly became worth fortunes. The same investors who once questioned him now watched as his predictions came true, while much of the financial world suffered historic losses. Burry's hedge fund generated extraordinary gains. By the end of the crisis, his investors had earned hundreds of millions of dollars. Burry himself made more than $700 million. But here's the fascinating part. The real story isn't about the money, it's about human behavior. Throughout history, financial bubbles have followed a remarkably similar pattern. A promising opportunity emerges. Early success attracts attention. More money flows into the market, optimism becomes confidence, confidence becomes certainty, eventually, questioning the trend becomes unpopular. People stop analyzing risks because they assume the future will resemble the recent past. Sound familiar? It happened during the dot-com bubble, it happened during the housing bubble, it has happened repeatedly throughout history, and it will probably happen again. That's because markets are ultimately driven by people. Technology changes. Industries change. Financial products change. But human psychology remains surprisingly consistent. Fear or greed, overconfidence, these forces influence financial decisions more than most people realize. Michael Burry's success also highlights another important lesson. Independent thinking has value. Most people rely on headlines, experts, and popular opinion when making financial decisions. There's nothing wrong with seeking advice, but blindly following the crowd can be dangerous. The majority is not always right. In fact, some of history's greatest opportunities appeared precisely when the majority was wrong. Burry wasn't successful because he possessed secret information, he simply looked where others refused to look, he examined the details, he questioned assumptions, he followed evidence instead of emotions. Those habits made all the difference. Another lesson comes from patience. Today, social media celebrates quick profits and overnight success stories. People want instant results, they want winning stocks tomorrow. They want wealth without waiting, but real investing often works differently. Burry's trade took years to play out. For years, he looked foolish. For years, he lost money on paper. For years, people doubted him. Yet he stayed committed because his research supported his conclusion. Sometimes success isn't about making the perfect decision, sometimes it's about having the courage to stay with a well-researched decision when everyone else disagrees. Michael Burry didn't predict the future, he simply saw reality more clearly than everyone else. While the world was chasing profits, he was studying risks. While others trusted the crowd, he trusted the numbers, and when the system finally cracked, the difference between popular opinion and reality became impossible to ignore. The uncomfortable truth is that every financial bubble begins with a story people desperately want to believe. In 2008, that story was housing. Today, it may be something else. The names change, the assets change, the technology changes, but human nature doesn't. That's why the real lesson isn't how Michael Burry made hundreds of millions of dollars. The real lesson is that the greatest financial opportunities often appear when independent thinking becomes unpopular, because in every market, there comes a moment when following the crowd feels safe, and questioning the crowd feels foolish. But history has a strange habit of rewarding the people willing to look where nobody else is looking. So the next time everyone agrees that something can only go up, ask yourself one simple question: what if the one person everyone is laughing at turns out to be right?